Right, hello. We are going to be talking about monetary policy and asset allocation in this presentation. And the topics that we're going to sort of focus on or center the discussion around are first, the global growth and inflation outlook, then what to expect from central banks, and then finally finish up with a look at some of the sort of key risks and opportunities across the major asset classes. So it's going to be a bit longer than usual, but bear with me because there's some pretty interesting charts and insights in this one. So first, just a little bit of background on me, the speaker, Callum Thomas, Head of Research and founder at Top Down Charts. So started it back in September 2016. Pretty much the reason for being is of Top Down Charts is to add analytical muscle to active asset allocators, and that's along the lines of investment ideas, risk management input, meaningful macro insights. And the approach is very much top-down, macro, data-driven, chart-focused, happy to use technicals and fundamentals and anything else that matters. And of course, that charts are greater than opinion. And I guess, given that the clients are in the sort of hedge fund, pension company, and wealth manager space, and being focused on asset allocation, tend to have a bit more of a medium-term view. Definitely include the shorter-term ideas and tactics from time to time, but if you think that I'm taking a medium-term approach, that'll sort of help you see how some of these things are fitting in. So straight into the first one, global growth and inflation. So the first chart here is property prices in the major economies, and anyone who's been following me knows that I like to look at what's happening with property prices, and there's a good reason for that. In the financial crisis, the subprime crisis, obviously what precipitated it was that downturn in the housing market, and that actually got underway, with a bit of a lag before the actual crisis kicked off. So, if you'd been focusing on that, then you probably would have stepped aside a little bit earlier. And by the same token, if you fast forward to the 2015-16 period where all of these had actually started to be in the expansion mode. So all four of these major economies had rising property prices, and at that time we were going through two stock market corrections, and there was quite a bit of concern and panic around that one, and rightfully so, because as you can see there on the global trade chart to the right, around that period there is pretty much a near-miss global recession. I mean, a lot of emerging markets actually managed to go right into recession, and we got an earnings recession, and so it wasn't as clear cut as it might, as some of the other corrections have been, where it's just the process of buy the dip. But when you look at the background of property prices increasing across these major economies, there was one thing that certainly gave me the confidence to have high conviction in the buy recommendation around that time. And likewise, what was going on with global trade, some of those indicators are starting to turn up and stabilize, and it's pretty key because especially for global trade, it's probably one of the major pillars behind the synchronized global growth outlook. And it's a pretty interesting picture there because it's quite contrast to this whole rhetoric and scariness that we had around protectionism. Protectionism was supposed to put a lid on what would happen with global trade, but as you can see with the leading indicator, we're actually seeing potentially brighter times yet for global trade after that rebound from the global trade recession. And talking about synchronized strength, if you look at the developed economies in particular, we're seeing indeed synchronized strength across USA, Eurozone, Japan. These indicators here in the chart on the left, they are a composite of the manufacturing PMI, the other PMI, consumer confidence, basically all the different economic confidence and surveys for that country. So it's a sort of a composite economic sentiment score, and you can see there that there was this, universal synchronized upturn that began in 2017, and has remained intact. And then you pair that with the chart on the right, and you see developed economies running out of spare capacity, and whether it's industrial capacity utilization or labour market measures of capacity utilization, capacity is tight. And when you combine improving, economic confidence, improving demand activity with tighter capacity, that leads to inflation. And really, that's pretty pretty normal, I suppose you'd say. Pretty mundane. It's just a normal part of the business cycle. And you know, I did use the unemployment rate in that other chart, and I guess if you look at these two, they're sort of more focusing on America. And sometimes people look at the unemployment rate and they say, well, that's not really the best indicator. There's all these flaws with it, and it's not capturing this, that, and the other thing. But then you look at this chart here that I've got on the left, and the grey line is from the Consumer Confidence Survey that's asking people, how easy is it to find a job? And at the moment, it's very easy for them to find a job for the average respondent, and you can see there it's very similar to what we saw around the late 90s, actually. And likewise for small business, they're actually finding it very difficult to find employees at the moment. So, it's consistent with what the consumers are saying, and consistent with the signal that we're getting from the unemployment rate. So signal-wise, the unemployment rate, maybe it's not perfect, but the signal that it's giving us is that the labour market is tight, and that signal aligns with, independent verification from these other sources. And, taking that unemployment rate and pairing it again with another pretty important indicator, the yield curve, so the 10s minus 2s, you can see there that this gives you a sort of a view on the maturity of the business cycle. And I guess, as the cycle does proceed and as capacity tightens up, these are the kind of things that you see towards the end of a business cycle. And that's for a few reasons. When capacity tightens up, that can lead to higher inflation, and when you get if you've got like a rapid increase in inflation, then that's going to trigger off the central bank to do monetary policy tightening. It's also going to start to weigh on profit margins, and so we're definitely late in this cycle, but the cycle, there's not really any really compelling signals that the cycle is turning yet. But as you get later in the cycle, it does make things more interesting, more challenging. It changes a number of dynamics, and really one of those key dynamics is monetary policy, which we'll get into straight after we look through the summary of this section. So just a quick summary on the global growth inflation outlook. So global growth, number of factors: rising property prices, global trade, which we showed, which I didn't show, manufacturing, and corporate earnings. Corporate earnings have actually seen decent growth across countries, across the world. And likewise, globally, we're seeing strong consumer. And these are sort of symptoms, signs, and reinforcers of the synchronized upturn. And the synchronized strength is particularly evident in developed economies. And the other theme is the maturing cycle, so definitely seeing signs that the cycle is maturing, but not over yet. Tightening industrial and labour market capacity utilization, and the next step is inflation. And the next step is what happens with monetary policy. So what to expect from central banks? 2017 was kind of a very interesting year for monetary policy. You might have missed it, but marked a pretty key turning point in global central bank balance sheet expansion. So you can see there on the chart on the left, even without giving any context or explaining it, you can see that the rate of change or the pace of balance sheet expansion has turned the corner in ECB, in Japan, and of course now we've also got the Fed is already embarked on quantitative tightening. You can see there that I've showed this on the chart on the right, basically the cumulative amount of quantitative tightening that is going on. So you can see there that the rundown in Treasury holdings has been about 35 billion so far. Put that into context, at the height of QE3, they were buying, doing, total asset purchases were 85 billion a month. So, it's very much baby steps on this journey, this second experiment in monetary policy, which is the coming full circle of the initial experiment of quantitative easing. But anyway, just to give a little bit of context on this one on the left, the ECB's not much to really add there, aside from the fact that most people would be aware that the ECB is going to be winding down its QE program. I would say, my guess is that they're probably going to stop by or at September, and unless market economic conditions can change materially from now, that's probably just going to go as planned. So, it's going to follow in the steps or the direction of that blue arrow. We already know what's going on with the Fed, which is the black line, going from, just maintaining its balance sheet to now running it down. The grey line, though, is kind of the grey area. Very interesting one, actually. So the Bank of Japan managed to get its taper, kind of a stealth taper, implemented last year. And the way that it did that was it changed from we're going to buy X amount of assets each year to we're going to keep the 10-year bond yield at or about 0%. And in the process, they've actually stepped back from easing. You can see that the pace of expansion is steadily reduced. But the interesting part is that whole 10-year bond targeting thing. So we've seen a few attempts for the market to push 10-year bond yield away from zero to the upside, and every time it's failed at 10 basis points. That's obviously their line in the sand, or their red line, in the today's parlance for this sort of thing. That's going to be an interesting showdown this year, I think. You look across global sovereign bond markets, and the trend that we're seeing is bond yields are heading up, certainly in America. And it's kind of reinforced by this whole stepping away from quantitative easing by the ECB, and already into tightening by the Fed. But it's almost a little bit perverse in a way too, because you think about the target or the objective of keeping a 10-year bond yield at 0%. If you get upward pressure on bond yields, then you do more purchases. So usually what leads to higher bond yields is better growth and inflation outlook. So if Japan's economy, global economy, is doing better, then that's going to put upward pressure on the JGBs, and that's going to force the BOJ to buy more. And that doesn't really make sense. And when things don't really make sense, they tend to not be done. Well, there's plenty of examples of them being done, but what I'm getting at is that they managed to do their stealth taper. They managed to kind of almost sneak that through without really shaking the markets at all. But they're probably going to have to drop that 0% targeting thing, and I don't think that they're going to be able to get that through as easily as they did the stealth taper. So that would be probably the biggest unknown. The ECB stopping QE is kind of a known. There's little bits of unknown about it. The Fed doing quantitative tightening, they've already communicated their plan, so it's kind of a known. Just because something's known doesn't mean it's not going to be relevant and impact markets. It certainly is, and that's why another catalyst or reason why you'd expect higher bond yields, as I'll talk about a little bit later. But the big unknown there really is the Bank of Japan, and yeah, that is one to watch, and that is, aside from the ripple effects that's going to have on global markets, obviously that's going to be highly meaningful for the yen and for the topics. And Nikkei talked a bit about that in the latest weekly report, so if you wanted to see more about that, just let me know. But back to the topic. So it's not just central bank balance sheets, it's also the traditional policy rates. You can see there in the left-hand side, DM, developed markets composite policy rate, so it's GDP weighted. And you can see there that, clearly turned the corner. There's, obviously a big part of that's the Fed, but there's a few others that are slowly stepping away or stepping towards that hiking phase. Bank of Canada, for example. And then probably more noticeable is the line below it, the darker blackish color. You can see there that, just to explain that first of all, that is the shadow rate composite. So the shadow policy rate is calculated by some researchers at the RBNZ, the Reserve Bank of New Zealand, of all places. And basically it's designed to give you a look at what's the policy rate once you take account of the quantitative easing or balance sheet maneuvering that's going on. And so you can see there that, in 2016 there's substantial easing, like over 150 basis points cut across developed economies, effectively as a result of increased quantitative easing efforts. And that was really key as well. If you think back when I mentioned about property prices and global trade being, reasons to be optimistic, then you throw this in as well, and the conviction levels rise significantly. Not only that, it's a correction to buy into, but that indeed that's actually the start of a new bull market, which turned out to be. So now we've actually had that basically fully unwound. And so, this is, there's a few things that can end business cycles and market cycles. One of them is policy, and at some point these two are going to be tightened enough to, end the business cycle, end the market cycle. The other is financial crisis. But those are the two key ones, and so this is really a key chart to be watching here. But one reason to not be running to the doors straight away is the black line in the chart to the right, which is this is the rolling 12-month sum of net rate hikes versus cuts across developed markets and emerging economies. So, developed markets were busily hiking rates, meanwhile EM were cutting aggressively, and we can see that very, very more noticeably on the chart to the left here. So the composite monetary policy rate across emerging markets, they were undertaking a renewed easing wave in 2017. So it was developed economies doing the big ease in 2016, then EM in 2017, and that sort of helped, at a global aggregate level, sort of offset that, and certainly turn things around on the cyclical aspect. Honing in on one particular part of that though, and I should mention too there that you can see that it's stabilized, and back in this chart here, it looks fairly clear, even if you just look at those indicators alone, that they're at the end of their collective easing cycle. And you look at some of the economic data and you'd believe that as well. But you look in the China one here, and so this is the stimulus indicators for China, the monetary conditions, monetary policy in the blue, and fiscal in the black. Again, looking back at that 2015-16 period when you saw those turning up, well, when I saw those turning up at the time, given how critical China is for commodities, at that stage I was saying, there's only one way for commodities from here, and that's up. When China eases, you buy commodities. And now that this is actually starting to turn the corner, it hasn't gone aggressively to the tightening side. So I guess at these levels it would be a bit more neutral. but certainly not the tailwind that it once was. So I guess it's kind of meaning gives presenting a bit of a complex outlook there and uncertain. Um, there's every potential that you could actually see them go back into easing mode. Property price gains have been slowing down. Um, you know, Market interest rates have been rising across a number of metrics in China, and you know, when you pile on debt like the way that they have been, you increase your interest rate sensitivity, quite notably, and that's probably one other key risk areas. How does China deal with higher interest rates that are going to be, presented to them by the Fed, by global markets? So, maybe they do look to try and offset that, but maybe they'll need to see a bit more pain. We did see weaker PMI out for February. Part of that's down to the Chinese New Year effects, but it's certainly one that's um, up there on my mind. I guess if I saw these indicators show a more distinct tightening phase, you know, monetary policy, fiscal policy going from very strong tailwind around here to more meaningful headwind already. Or you could say that that's presenting a bit of a headwind, but you know one that's definitely on the radar. So what to expect from central banks? The three key takeaways here. So quantitative easing, the tides are turning, well, they've already turned basically. Developed economies, along with the journey from QE to QT, traditional policy tools are also turning. So policy rates are on the rise. Emerging markets, after a renewed easing wave last year, EM is about to turn the corner on policy as well. So it's sort of a overall a picture where quantitative easing's turning to quantitative tightening, and that's taking a tailwind for asset markets to a headwind. Policy rates are rising. Going to be, I think the predominant trend is going to be for policy rates to rise across the world, and that has a number of important implications, particularly for asset markets, which we will get on to right now. Risks and opportunities. So first one we're going to have a look at is bond yield. So chart on the left kind of defines or really summarizes the medium term view for 10-year bond yields or US government bond yields from this point. A lot of people are pointing out the breakout from the downtrend line, and technicals certainly very useful, particularly at turning points. But having a technical view is one thing, having a fundamental view to back that or reinforce it, can be even more powerful. And I've got IMF forecasts in here, but you could probably put just about anyone's forecasts and factor in where we are in the cycle, where the global economy is heading, impact of tax cuts, and so on. And the longer term measure here, so it's the 10-year compound annual growth rate. That's what CAGR stands for. The longer term growth rate is turning the corner, and if it follows that script to precisely, then that means that by the time 2019 rolls around, we're probably going to be seeing the 10-year just rolling around that 4% level. So that's sort of my medium-term view there, and the fact that quantitative easing is turning the corner as well. It changes the supply and demand dynamics in the market, and sort of reinforces that view. Short term, it's going to have a lot of chopping around. I had an article out earlier today, and showed how sentiments managed to switch all the way from bearish to from bullish to bearish, and in an extreme manner. And usually when you see that happen, that tends to create the conditions for a pullback. And a somewhat related. The one on the right sort of presents a medium-term bearish bias for the gold price. So you can see there the blue line is the shadow Fed funds rate. It's the same one that we were talking about before, and that's shown inverted, and that's basically showing not just the impact of traditional policy, but also of quantitative easing. So the tides are going out there. And, if quantitative easing, if you think that it was a benefit for gold, in the early part of that, then, it's logical that it would be, going against it at this point. I guess the key sort of risk management note for that chart or for that view is where gold is tracking at the moment. You can see there, I haven't drawn it in, but there's pretty clear line in the sand around 1350, 1400. If it managed to break out of 1400, it's probably just going to keep going. So, you have your fundamental views and you keep track of these kind of indicators, but, sometimes you just have to listen to price. If the gold price goes above 1400, then, it's probably going to keep going. And to be fair, if it does end up getting above there, then something's probably changed in the fundamentals at that point anyway, because, price moves faster than fundamentals. But if it fails, then it's going to be even more meaningful, because that is a pretty key resistance level at that 1400 level, and if it fails to breach that, then it does open up the downside, which could be as low as 1000 or lower, particularly if quantitative tightening proceeds as expected, and or even faster than expected. The tightness of the US labor market, and combine that with the tax cuts, and anecdotally the tax cuts have already triggered off a bit of a flurry of activity. So there's every possibility that we could see the Fed hiking faster than expected. I don't know if they would necessarily accelerate their quantitative tightening plan, but the original plan that they presented us was that it had automatic increases sort of inbuilt. So I guess the bottom line there is that if you think that blue line is a headwind now, that's only going to increase in intensity. Now the second set of charts on risk and opportunities is looking at global equities, so taking a global perspective here. Really sort of two defining charts here, I guess, in a way, for global equities, especially at this point in the cycle. So we'll just go through and explain them first before we sort of tie it all together. The one on the left shows you in the brighter red line is the percentage of countries where their forward PE is trading, at quite a bit higher than usual, and the darker red line is where the proportion of countries where the forward PE is trading significantly higher than usual. And really what that's saying is that we're seeing more and more countries showing up as expensive. It's nothing like what we saw in the late 90s, where basically the majority, not all, but the majority of countries were trading at pretty expensive forward PEs. I guess one thing too to note about the early 90s and the late 90s is that we can go higher from here, and that's certainly possible. But even I guess the counterpoint to that is that at these levels we're matching what it got to prior to the 2015-16 corrections, which at a global level was much more substantial than it was, say, for just US markets alone. And of course, ominously, at the sort of 2007 market peak there. So it can definitely go higher from here, and that's one truth, and the other truth is that things get riskier from here. And talking about risk, something that people sometimes call risk volatility. Um, I first showed this chart earlier in the year. I think I should remove the question mark now because that little spike there wasn't in there the last time I showed it. But yeah, basically, I'm pretty confident in the view now that the equity volatility's bottomed. We're going to see it calm down, but I think that we're probably going to stabilize around these levels. I think we're going to return to those very low levels of volatility, and that's actually pretty normal to see at the later stages of market economic cycle. And there's a few good reasons behind that. You always want to think about, when you're trying to figure out where markets are going and looking at price charts, you want to think about, thematically, what fundamentals are going to be supporting that. And the transition from monetary policy being, a great tailwind, a great easer. One of the benefits of countercyclical monetary policy is a dampening of volatility, and certainly, it's fair assertion to make that this dampening, crushing of volatility was facilitated by central banks easing during that period, and we talked at length about that in the previous section. And so if they're moving from easing to tightening, that's a pretty good reason to expect higher volatility. Higher volatility from the point of, seeing the cycle maturing, but, obviously along the way, as you tighten policy, there's that old market aphorism of 3 steps and then a stumble, but, the reality is any step in monetary policy, particularly on central bank balance sheet management, any step there may be a misstep or, for markets. So, there's a real possibility that we get a, price fall driven spike in volatility, because that's the other way that you get higher volatility is that just from markets falling and people panicking and getting that as a contrarian signal. And the last set of charts, kind of my favorite pair of charts at the moment really, is the view of 3 different asset classes on the left, which is treasuries, government bonds, S&P 500 and property. And these are valuation metrics. They're standardized, so they're Z-scores, so this is how they're trading versus history. And you can see there that property is more expensive than usual, stocks are more expensive than usual, and bonds are more expensive than usual, although that story is starting to change. And it's quite a unique period in history, actually. You can see there, bonds when they were at their most expensive was when, QE was at its height, quantitative easing, so you could definitely call that the bond bubble, the quantitative easing driven bond bubble. And then, back in the late 90s, you had the stock bubble, and in the mid 2000s, the property bubble. And at the moment, I would definitely wouldn't call this a bubble, because the bubble's more extreme. Like, you look at the late 90s and the mid 2000s, those are bubbles. But it is rather unique that all 3 are trading in very expensive territory, and it certainly makes job of an asset allocator a bit more difficult than usual. And you throw into the mix of this chart on the right, and that shows you basically just 2 different measures of cash allocations. One's derived from fund assets, and the other one's derived just from the AAII survey. So whatever way you look at it, cash allocations are pretty low at this point, and so I guess if you're the contrarian in the room, you might look at this and say, well, people are all piling into treasuries, property, stocks, and making them too expensive and going out of cash, so I'm going to go the other way. And it may well be that cash is the only place to hide. If treasuries unwind their overvaluation in a rapid manner, then that's going to hit property, going to hit stocks, at least short term. And yeah, so it's about it. I'll just finish off with some with the conclusions for the risks and opportunities there. So fixed income and commodities, bond yields biased to go higher over the medium term. Gold is at risk from QT. Global equities got higher valuations, a changing volatility regime, and a maturing business cycle in the background, so that equals harder times ahead. And really that means that your focus on risk management needs to be on form at this point in the cycle. You need to have a plan, you need to have a process. Ideally you would have a list of indicators that you're watching to stay on top of, because if you think about the prospects of a bear market, because risk management, it's about trying to avoid permanent loss of capital. That's the biggest thing really about risk management. It's not, the smoothing out of returns, which can be relevant, but so in terms of dealing with a bear market, there's basically two major taxonomies of approach, I guess, I suppose. Is the first one is that you are preventive, or you try to do it beforehand. You notice that valuations are heading up, and that that we're getting towards the end of a cycle, and you decide to step aside. The downside of that is that you step aside from the market at this point. As I showed you before, valuations can go from expensive to even more expensive, and things could rocket up another 20, 30, 40% from here. Then the other way, reactive. So proactive versus reactive. The reactive way would be to say, okay, I'm just going to wait until S&P 500 goes below its 200-day moving average, and I'm going to watch for other signals like a turn in the fundamentals. I'm going to wait for earnings to turn down, economic cycle to turn down, monetary policy to get even more tighter, yield curve to invert. And once all these boxes are ticked, then I'm going to sell. And then of course the risk with that approach is you get some sort of 1987 situation where the market moves much faster than your checklist does, and you end up scratching your head as you missed a major move. And so neither method is perfect. A blend of both, I suppose, is probably the best way to approach it. And personally, sort of changed the recommendations to be a bit more neutral. Overall equities, developed market equities, but there's still pockets of value out there. So relative value is still key. Emerging markets, something that sort of stick out even after a substantial run. And there's a few other ones that we've been talking about as well, that where there's pockets of relative value, across countries, but also across sectors. Getting harder to find, but there's still some. So again, have your plan, have your risk management in place, and then that brings us to the final point there, which is about cash. And sort of again thinking about that growth versus defensive mix, and what do you do when all asset classes look richly priced? About a year and a few months ago, the phrase at that time would have been TINA, TINA. There is no alternative, because when cash was at zero, there was no alternative. But now that we've had quite a string of Fed rate hikes, above, about 100, 1.5% now. There is an alternative, and there's the return aspect of cash, but then there's just the whole preservation of capital. Cash is just about always going to perform its job of preserving capital. There's exceptions to that. Obviously, there's exceptions to just about everything, but compared to bonds, which are still expensive on my measures at the moment, do bonds do the job of a defensive asset? Well, they haven't really performed too well in that respect lately. And if you had a real surge in bond yields, potentially as a result of some uh, QE misstep or QT misstep, then certainly could be one of those nowhere to hide situations in markets. So on that bright and cheery note, I'll leave it at that. I did take a bit of a sort of bearish view towards the end, but I think that I've still got a pretty constructive view at this point. Certainly wouldn't be running to the exits just yet. There's a few things that are that are on my radar on the risk front that I'm definitely keeping track of. But there's no real, all the traditional warning signs aren't really showing up in a meaningful way just yet. So look, I'll leave it there, and if you had any questions, comments, go ahead and put them in the YouTube comment section below, and be sure to subscribe to the channel so that you don't miss any future updates that I'll put out here.